Hello, everyone, and welcome to our June investment market update. I can't believe we're already halfway through the year. Today, I'm delighted to be joined by Wayne Bishop from King & Shaxson. Wayne, how are you?
Very well, thank you, Michael. Very
Good,
well
good. Thanks for
indeed.
coming again. You've obviously been on a couple of times now, and I think it's about time that you came back on again. So we had a chat a few days ago, and there's obviously some very topical themes coming our way that hopefully you're going to touch on today. And I understand you've got some slides that you're going to bring up, and hopefully be able to go through a few of these very pertinent issues at the moment. We're obviously a couple of weeks away from the UK election, and I know you've got some thoughts on that, amongst other areas as well. So if you're happy to bring your slides up, that'd be great.
Brilliant. Well, good morning, everyone. And what I'm just going to share here quickly are just a few thoughts about how the more impact and ethical space, if you like, the darker green space, is coping at the moment with the markets around us, and a little bit about what we're expecting to happen, because as Mark said, there's going to be elections, and of course we are in the middle of a lot of elections this year. This is not just the UK having elections. We finished this year with what I've termed Battle of the Dinosaurs, or the American election, where obviously we got two very old presidents really in quite an intense battle. We've had elections going on in India that were a bit of a surprise. And although India may not appear that important on the global stage, economically, it is really rising in significance. And that is a factor we can't ignore. In the same way China did 20 years ago, 25 years ago, they went from nothing to being a very large and important nation. India is probably just a few years off reaching that same stage. So there's a lot going on in the global dynamic right now. But just to sort of come back to what's been happening here, this first graphic I just wanted to show you talks through perhaps how ESG investing, i.e. the lighter green investing based on best of class, but including most sectors, versus impact where you have, say, a strong emphasis on the positive and a complete avoidance of the negative, have performed relatively to each other. And what you see is that for many years they performed in tandem. And in fact, I could stretch that graph way back to, say, 2012, 2013, it would look similar. The fact is, its impact wasn't perhaps so well known then, so I've chosen that date. But then, of course, around COVID, they stretched out, impact outperformed, and then since COVID, it's gone the other way. And there's a big spike towards the end there, which is still this outdated N7 argument that continues to go on. And of course, Nvidia have made the headlines today, becoming the world's biggest company again. And so we still got that battle going on a little bit. We have Nvidia in portfolios. We would have Microsoft in portfolios, but you won't have the likes of Amazon, Apple, Google, or Facebook in portfolios. They do not meet the screens when it comes to corporate citizenship. What we mean by that is they're either aggressive tax evaders or they are very poor on labor records, as well as on data protection. So that tends to sort of rule those stocks out. And of course, they're driven performance. Now, that argument is beginning to sort of subside because the interest rate environment is changing and the markets are sort of drifting down in capitalizations a little bit. So we're seeing that go on. And at the same time, of course, renewable energy, which peaked in 2000, has also been coming down as one of the positives. But we see the world turning in renewable energy. And you can see at the end of that graph, it's beginning to sort of show sort of around here. It's beginning to sort of show signs of life again. And we see the outlook for renewable energy being really strong and positive at the moment, not just driven by the environmental factors, driven by the global energy security factors. Now, would elections undo some of that work? Well, America's been a little bit slower anyway, partly because of backlash out of Texas, but the projects are going ahead. And a lot of these difficulties have been more about pricing. Some of these agreements were made many years ago. The prices have risen, the prices of the raw materials have risen. But America, in particular, has been quite flexible in rearranging or redoing some of the deals. And so those deals that were causing a headache, say, a year ago because of costings, are now sort of being reworked and they're coming back to life. So we are seeing some of those big renewable energy projects really start to show signs of life again. And at the same time as this going on, we are also seeing good strength in other positive areas. Oh, I've missed that slide out. Oh, I do apologise. Here, water and healthcare. Water has done very, very well. Healthcare has really come back to life very recently. That had lagged a little bit in the post-COVID world, but we're seeing some real strength there, not just in, say, the pharmaceutical companies, but a lot of the technological companies, particularly one, as you incorporate AI, two, as we have to find more novel ways of approaching diseases. And of course, there has been a big sense of excitement along with the GLP drugs, the anti-obesity drugs. Now, there are some concerns some of those are being misused, or they're selling the GLP drugs at the expense of the original diabetic drugs. But that's working itself out at the moment. We tend to be slightly less exposed there, but more exposed to a lot of those people who are really trying to use AI technology and grow more modern personalized drugs that are very important. The reason being is demand for these drugs is going to get higher, particularly as sort of Asia, etc., starts getting more of the problems that the West have had. But at the same time, we've got to be far more efficient in the way we address these areas. So healthcare has done very well. Water, ignore the scandals we hear about Thames Water. That's not good news. It's not something we're invested in, but various other projects are really taking off around the world, and the need for good water is very important, particularly with the climate confusion or the climate damage we're seeing at the moment. So those areas are all looking very positive at the moment. And finally, that mid-small cap dynamic that I've talked about before, that has widened out. That's driven by the M7 that I talked about earlier. But smaller companies and not so large, or I should say still very large companies, but not the mega caps, which tends to be where the portfolio is aimed, more in those sort of what we say smaller large companies and medium-sized companies, they are beginning to show signs of life. And when we talk about the election, I think that is actually one of the areas where things could change. The same comes here for really real assets, infrastructure that suffered a lot with the interest rate hikes and a lot in the post-Liz Truss environment when the infrastructure pipeline dried up. The interest rate scenario is very critical for these. Most people are expecting interest rates to sort of come down in the UK. There's a lot of emphasis on the August meeting after the general election, when we're out of the zone of politics, that we might start seeing interest rates come down. I know there was a little bit of pullback today on the back of some of the inflation numbers, but inflation is back under control now, and political fighting and political difficulties will end in the UK with the election. And that to us is actually very important, not necessarily because of who wins and who doesn't win. The main result that most of the market wants to see, and to a large extent expects, is that we will have some stability. We will have a government with a majority, and a majority that means that they're not going to be in hock to minority interests and worrying about various vested interests screaming and having control over the government. Why does that matter? Well, the UK has been really ignored globally since Brexit. Not a political view, but while we've been working through all the difficulties and working through what has been a very, very traumatic experience economically, the rest of the world has moved on. We've kind of had to deal with this and wrestle with it ourselves. It's gone on for about 8 years. And the fact of the matter is while that's happened, the rest of the world have had plenty to do, that they've just let the UK's been left out in the cold. Last week in some of the auction results, we saw some very strong demand for longer dated bonds. And what we're beginning to feel is that the rest of the world is now interested in the UK again. Why? Sterling is very cheap. Why? Well, America's got enormous issues coming up with its election now. It has been the model economy. It's been the textbook economy in the world. People are beginning to wonder if it's now so overvalued that money's pouring out. Europe is in all kinds of difficulties. We've seen the French elections. The Germans are politically listless and economically very concerned because the car industry is such a significant part of their industry, and the Chinese are really having an impact on them. First of all, they're losing their export markets to China because China is now buying Chinese cars. And secondly, obviously, China is sort of invading the West. And in fact, the funny thing is that after the EU announced their tariffs on Chinese cars, Chinese car makers' share prices actually rose because those tariffs were not as bad as feared. But the fact is that Europe is not as easy at the moment to invest in, and there's a lot of political confusion, especially since the French announced their election. China is still struggling a little bit, and of course is out in the cold. People have revalued or reevaluated how they look at China. Japan is doing very well, but there's really only a certain amount of people can really put into Japan. And then finally, India is the new boy. It has attracted a lot of money already. There's still complications with India. It's not a completely open economy. It is not, if you like, up to the institutional standards that many people want to be in. We are, if anything, slightly overweight India in the way our portfolios are constructed. And we certainly believe there's a lot of potential there, but it is going to take a little bit of time. So it's a slightly long burn. That means that the UK, still one of those G7 economies, is perhaps looking slightly more attractive. And I think, provided our election gives us a government with a majority, I'm not really bothered politically which way, that should give some stability. And at the same time, that should also help the real assets and the real estate assets as well, where infrastructure has been put on hold. Nobody quite knows what's going on with projects. And a lot of what we're invested, not just in the infrastructure asset class, but also via the equities, is obviously based around people building out. So that's where we are positioned at the moment. And I think where we see the election, as long as it provides stable government, giving a boost to the UK in two areas: one, global interest, and two, more into the area of stability. I thought perhaps what I'd do here is now look very quickly at how we have focused a portfolio. We're focused around a number of sectors. What I've done here is just picked out three. Clean energy, we're still in there. We've got the makers of the equipment, such as Vestas. We've got the operators like Greencoat and Foresight. ITM is also a very small investment in some of the high risk areas, because that's one of the main plays on green hydrogen. And in the middle, a company called Cadillac, who are basically focused on shipping the turbines out. They're one of the main boat owners, if you like, who own the boats that take the turbines out to sea. As we sort of flick across, we've also got quite a bit of interest still around electrification. So you'll see these kinds of stocks in portfolios, and alongside them another French stock called Schneider. They're very much focused around electrification, around infrastructure that is now enabling so much of the renewable energy and the energy efficiency to take place. They're also very much involved in the EV infrastructure, in other words, charge points, in particular ABB, in industrial charge points that go around for big vehicles, buses, etc. So they're all involved in that area still. And then finally, sort of what I would also have a look at is waste and recycling. This is an area where there's still a lot of interest. Now, water has been a difficult topic with Thames Water. We certainly don't hold any Thames Water bonds. The closest we have anything to Thames Water is Tideway, which is the Bazalgette bonds, and also some of the infrastructure investments around the super sewer under London. That's not owned by Thames Water. Thames Water just pay to use it. But that project has obviously had a significant impact on London, and should have a significant impact on the cleanliness of the Thames, as we have a modern sewer capable of coping with the very large city that London has become. But we're also involved in sort of metal recycling, which is Arubis and Befesa, and Renewi, which is much more European focused and focused merely on more general building recycling and waste recycling. But we still see these as all important areas. Alongside that, we have, as I've mentioned, we have sectors such as healthcare and education that are also key areas for growth in the future. But I hope that just gives you a picture of how we're positioning ourselves at the moment. Over to you, Michael.
Yeah, no, that's really, really good. I mean, I think the comment I would make is, you made the point about the UK election and the fact that having an outcome that gives stability is really important to the markets. I was intrigued to hear that you felt that the UK is now sort of emerging again after being really in the shadows for the last 8 years. And I think it's been plain to see, if we look back even 10, 15 years ago, when we look at portfolios, the UK had a lot more exposure, or rather portfolios had more exposure to the UK, but progressively over the last 10 years, we've seen that move away. So I guess a question I've got for you is, how much do you think is going to start flowing into the UK? Do you think it's going to be quite a positive impact now? And are you going to start seeing maybe these infrastructure projects really getting some traction as interest rates start to drop?
Yeah, I think the fall in interest rates, I think, is quite important. The thing with interest rates hasn't so much been the mathematics, the logic, the mathematics behind infrastructure, because most of the debt was hedged. So it hasn't been so much the textbook; it was more the substitution effect. And this was Thames Water's problem. Typically infrastructure assets were yielding around 6.5%. This time last year, you could get a UK government T-bill for 6%. Now, a UK government T-bill is the lowest risk investment you can have. Your counterparty is the UK Treasury, and you could lock money away with them for 6 months for that kind of money. You would have had to have been clinically insane, or perhaps another way of saying it is, if you're an institutional investor, you actually would have the right to shoot you if you made an investment in infrastructure for relatively little gain. So we need cash to sort of come back to about 4.5%. It's now roughly at 5.2% for the same period now. And I think once we start seeing some move on interest rates in the UK, obviously then assets such as infrastructure will become more attractive again, because you get that yield differential. I
So
think
you
that
mentioned, I was going to say, you mentioned that obviously we've got the election in a couple of, well, just over 2 weeks now, time. And once that's gone through, hopefully they'll be settled, and then there'll be a Bank of England meeting in August. Is there anticipation they will make changes then, or do you think they're really going to make sure that things are under control before they start to sort of shave off some interest rates?
I think the market is still pretty convinced that we should see the cuts pretty soon.
Okay.
So August is still very live, if you like, as a date for a potential rate cut.
Okay.
I think Europe's already gone ahead. US is slightly different because it's much more vibrant as an economy, because it really hasn't had any of the problems that Europe has had. The war hasn't bothered the US, and various other things haven't bothered the US. So I would say the market is pretty much regarding August as a live event. And certainly, if not, I think expectations then build up for September. But the inflation is a slightly lagging indicator some degree. So you have to think that inflation would continue to fall, even if they started to cut interest rates to start with, until there was until perhaps interest rates fell too far. I don't think they'll fall too fast too soon, because I think there will be a lot of caution around these cuts. But I think the market is definitely understanding there is a need, because I think a lot of the anecdotal evidence on the economies, and it's not just the UK economy, but every economy around the world at the moment, is not that great. Economies have remained surprisingly resilient, but I think people are aware of some of the risks. Now, that's to some extent priced into markets, so they understand those risks. So I don't think any of those risks happening is going to surprise too many people. The risk is, of course, is that they start to sort of snowball. So I think interest rate cuts are pretty likely in the second half of this year, not just in the UK, but also in Europe. The US is perhaps the only exception, because the election basically puts them in purdah, and that, of course, will take you to the year end now. But again, I think the markets are becoming quite accustomed to that.
So are you suggesting you don't foresee any US rate cuts this year until at least the election's taken place?
Yes,
Right.
I
Okay.
think
That's a big change, isn't it? Because obviously the markets at the beginning of the year were expecting it around the April time that they would start to see the Fed reducing rates. So that's quite a move. But I guess that's because they had the inflation numbers were a little bit stickier than they probably anticipated. And now they're in that season. I guess you're a few months out from an election, so they're probably going to sit tight rather than making changes. And I think it's interesting that Europe have gone ahead already, and normally you would anticipate that everyone would wait until the US made changes. But that's an interesting move, probably for the first time in history that has happened. But obviously it kind of shows also the independence that countries are now having, and saying, well, okay, we're in different financial circumstances. One thing I wanted to pick up on, I don't know whether you have any information on it, is understanding what's going on in, say, the UK in terms of companies and how they're surviving, and whether redundancies are becoming more more prolific out there at all at this time? Because I know everything's always a bit lagged, but are you seeing anything on the employment front that's changing that would give you an indicator that interest rates will also definitely be coming down in the near future to try and help the economy?
Surprisingly not. I think we're still having certain areas labour shortages and skill shortages, and most white collar work at the moment is, if anything, I think there's still people looking more in that wanting to employ people. What I think we've gone into is a period of sort of, not miserable prosperity, but the misery has come more about around interest rates and cost of living issues.
Mm.
My mouth dropped yesterday when the car insurance quote came through, for example, and I think a lot of people are finding these things happening. And interest rates obviously impacting mortgages at a slightly different pace than previously, as people have had fixed rate mortgages, and of course they're dropping off from very generous rates to quite awful rates. So I think what
Yep.
we've got is that slight period at the moment of people are in work, but they're pretty miserable because they're just seeing their real earnings getting eroded by either high interest rates or sort of knock-ons of inflation. So
And I guess
that
that's
is,
not really going to change anytime soon, because if people are locking in on higher interest rates because they have very little choice. So, we see it in the mortgage market where clients will either go on a standard variable, which can be anywhere up to around 8 or 9%, which is like ridiculously high. They can go on a tracker if they think interest rates are coming down, or alternatively they go on a fixed rate. So you get some certainty. Now, even with rates where they are right now, fixing in for 2, even 4 or 5 years means that you are accepting an increase in what your mortgage payments are compared to what they've been. Now, obviously, you highlighted that they were historically low and they come off very good rates. But it does mean that this sort of pain, I guess, will be here for some time unless we start to see good increases in salaries across the board to sort of give people that breathing space once more. Do you think that there's still going to be increases? I guess what I'm saying is, do you think the UK will start to prosper more, or are we going to sort of limp out of this over the coming couple of years?
we've got to grow, and I think we have growth at all costs from the current chancellor, if you like, and I think that will follow through to the next chancellor or whoever's chancellor in August and September, which really goes back to, I think, probably, if you understand history, I don't think we've really had that since Edward Heath, going back a long time ago. So I think that basically that is the only way we're going to work our way out, is through growth, prosperity, increased wages, increased efficiency. Now, I know a lot of people talk about the fact that productivity has been one of the things the UK's lagged, but those statistics are quite skewed towards the city and some very big factors that really go back to the sort of before the financial crisis, when deals were very large and compliance departments were very small, and the city has become less efficient, if you like, in that sense. But I don't think the rest of the nation is suffering from that same kind of inefficiency. So I think that there will be a need for higher wages, and I still think that there will be a competitive wage market out there for a number of set skills. So that's going to continue, and I think the areas where we lack knowledge, science, etc. We will be needing to bring in homegrown talent, grow homegrown talent, as well as sort of have an immigration policy that brings those people in, because those are areas that we need to develop. And I think really since COVID, science has become more interesting, technology has become more interesting, and we're going to all have to become a lot more technologically efficient, which I think has already happened. But I think with AI, that is going to continue to happen.
Yeah, absolutely. I think one of the things that I've come across going to a couple of conferences about obviously investments and everything else, and talking about AI, and this obviously we've managed to do quite well to get through 20 odd minutes without talking about AI actually, is about it becoming a working with it rather than replacing. It's about becoming more efficient, be able to do things, get hold of information quicker, and it's not at that point where anyone should be necessarily threatened about jobs or so on, but it's about making you more efficient in what you're doing. And I think that's where it's quite exciting just to see how that can actually improve efficiencies within businesses. So brilliant. Okay, so in terms of where you think the market's going over the next 6 months, interest rates, we're hoping, will start to come down a little in the UK from August onwards. The US, you think, are going to sit tight till latter part of the year. ECB, do you think Europe is going to slowly bring them down? You know, it's not going to be like big dramatic drops, but more bit here and a bit there.
I think Europe will be pretty close in lockstep with the UK, so I think Europe will
Okay.
be bringing them down as well. Obviously, we've got perhaps a slightly scary political scenario playing out in France now, and
Yep.
France being one of the major European economies, and as we said, Germany being quite stagnant. I know that there's some good industry in Germany. Germany's got some potential, but it's also got some big threats. So if you like, the drivers of the European economy are struggling. And more recently, it's been the other countries like Spain and Italy that have really reversed roles and have been the people driving Europe forward a little bit, driving some of the growth. But that's all quite temporary. Now, I think the ECB will be cutting rates. And the dollar the dollar is strong still at the moment. So I don't know if there's a great deal more dollar strength out there. But because I think a lot of this is priced in, which is why at the moment places like the UK still look very competitive, because in dollar terms we do look very cheap. And with that, and with the move towards the smaller large caps and the mid caps, which again favour some of the UK companies as well. We've seen a little bit of takeover activity start to pick up again in the UK. And there are some very good UK companies that are cheap. So I think there will be that kind of interest returning to the market.
Good. And that's all good signals, isn't it, of things starting to go in the right direction, and hopefully therefore some positivity over the rest of the year, assuming everything is relatively stable.
Mm-hmm. Yeah.
Fantastic. Right. Thanks so much, Wayne. Really appreciate you jumping on today. Everyone, thanks so much for listening. We will be back in a month for our July market update. Thanks, everyone. Take care.